Started my first startup in '97. The world told me I was insane.
Our goal is creating future economies that are more regenerative and sustainable.
Something didn't match up. Why hasn't this become the next big thing? And that's where we invested.
The whole purpose of achieving anything in life is measurement.
Welcome to the panel, our 11 o'clock Eastern slot, which is the intersection of insurance repair, maintenance, and ESG. So the panel topic will be about leveraging ESG wins to create value and insurance cost reductions. And on the panel, we have Dean Fung-A-Wing, who is the founder and CEO of Kairos, one of our portfolio companies, as I mentioned. So thrilled to have him here. And joining him is Joel Willis Jr., partner at IOA. And a quick bio on Joel. For the past 17 years of buying insurance for developers, real estate, and private equity firms, Joel has been focused on changing the facts of how insurance is based by transferring, mitigating, and eliminating risk. The strategy continues to be successful in the current hard insurance market. And Joel has a risk management and insurance degree from UGA. He's the president, TRS, chairman emeritus at First T Greater Charleston First T Golden Isles, and chairman of Happy Cup. Joel lives in St. Simon's Island with his wife and two daughters. Welcome, Joel. We also have Mandi, who is the founder and CEO of FEROCE Real Estate Advisors. And quick bio on Mandi. As the founder and CEO of FEROCE Real Estate Advisors, Mandi leads the team that advises forward-thinking real estate companies on how to position their assets and teams to succeed during times of disruption. 20 years of experience running billion-dollar real estate portfolios. She has delivered results to investors by leading change and creating value out of change. Her experience across multiple asset classes and multiple markets, spanning the life cycle of sustainable real estate investments, provides an insightful and valuable perspective to her clients. As a leader at a public REIT, Wash REIT, and at a private equity real estate investment firms, ASB Real Estate Investments, and Kennedy Associates Real Estate Council, she has built and led high-performing and diverse investment management teams while providing hundreds of millions of dollars in sustainable, reliable value to investors and customers. And joining us hopefully shortly also will be Akshay Gandhi, who is the SVP at Olive Tree Ventures. Akshay is a good friend to us here at Shadow and always appreciate his insights. Quick bio on him. He's responsible for the analysis, underwriting, and assessment of various acquisition opportunities and capital structures at Olive Tree. In addition to creating and maintaining various asset portfolio models, Akshay is currently focused on transaction due diligence, market research, and performance reporting. He has a BBA in finance and international business from George Washington University School of Business and a master's in real estate finance from New York University Schack Institute of Real Estate. So with that, Dean, I will turn it over to you. Just a quick reminder as the session moves forward, if you have questions, you can put them in the chat or the Q&A. And if there's time at the end, Dean and the panel will get to them. But having said that, Dean, I'll turn it over to you.
All right. Hey, everyone. My name is Dean, co-founder and CEO of Kairos. We're a digital water technology company focused on asset protection and water conservation. I'm excited about today's topic as we cover the intersection of these three main areas that affect everyone here on this call, and hopefully those in the audience can gain some value from the insight that we'll share today. You'll hear from these excellent speakers. When you think about the economic and physical life of properties being impacted every day, they're impacted in varying ways. It's a battle. You're controlling expenses, value, impact to those who occupy and engage with and own and operate real estate assets everywhere. It could be external challenges like climates and regulations and markets, economies, pandemics, internal business challenges, right? Like aging building stocks, operational inefficiencies and shifting demands of those that engage with these assets, right? Your residents, your tenants, your labor force, all of that is shifting, as time moves on. And today we're here to facilitate a conversation about how ESG, R&M, and insurance intersect, and why technology has a potential to unlock value in commercial and multifamily real estate. Putting sustainable financial principles into practice and operationalizing a more sustainable business model can offer many benefits, right? Including better performance, leading to greater access to capital, and in reducing risk and driving long-term value. So with that being said, we're going to jump right in, and this question will be pointed to Mandi, and Akshay can follow on. But let's fire away the first question. Would you help, Mandi? Because I know when it comes to ESG, it means different things to different stakeholders, right? If you're a clothing brand, ESG means something very different, right, to you as a clothing brand than it does if you're a real estate owner, right? I'd love for you to just bring some clarity as we view it through the lens of commercial and multifamily real estate. So if you would, with that, give us a baseline starting point for ESG.
Sure. Hi, Akshay. I'm glad you joined us.
Thank you. Apologies for the tech issues on my part.
All good. So I'll talk a little bit about ESG. I talk about it in, I add an R, ESGR. So one of the forces that's shaping real estate today and investing and the built environment is a holistic approach to sustainable investing. And that's capital S, sustainable. And in sustainable investing, you apply a discipline of an ESGR framework to achieve both strong risk-adjusted returns and a positive societal impact. You have to both make money and do good. And you must have one with the other. And so in ESGR, that framework, there are 4 interconnected pillars. And these are a set of standards that clothing manufacturers, lifestyle brands, real estate investors all use to screen potential investments, buildings or companies. And tenants also use them to decide where they're going to lease space or where they're going to live. Residents look at it from from whom should I rent an apartment? And customers look at it from where should I go shopping? Who should I spend my money on? And the pillars are environmental. Are you a good steward of nature? Social. What is your relationship with your employee, your supplier in the community where you live and operate? Governance. That's visibility and transparency into pay, audit, and shareholder rights. And then resilience, which looks at how properties, businesses, companies are prepared to address risk. Anything from valuation risk to weather-related events to a global pandemic or two. So at its core, ESGR is about creating long-term value through managing risk, building resiliency, and providing transparency and accountability. No, now we can't hear you.
Akshay, you want to tag in on that? How do you view this particular topic? Thank you, Mandi.
Absolutely. I mean, I would say that with regards to real estate and multifamily in general, right? It's about providing people with a place to live. That in and of itself, I think, is the largest space in which most people are going to spend their lives, workplace aside, of course. With that, I think comes a great deal of responsibility in terms of providing that in a manner that's conscientious with the rest of the stakeholders in a community, as well as to kind of, the broader tenant base or resident base at large, right? So whether that is looking at it from the standpoint of affordability, whether that is from the standpoint of, making sure that they are able to live in an environmentally conscious fashion, if that is something that they opt to buy into. And I think the responsibility kind of is now falling more and more on the shoulders of landlords to take that into account as they move to add value where they can in the lives of their residents.
Fantastic. Thank you so much. Mandi, how do you see the industry as it stands today, right? Like what's the current state? And then we'll talk about, certifications and other things in just a moment. But just tell me, we've typically reamed, commercial real estate and insurance, like, oh, they're taking forever to adopt such and such. But I feel like a lot of things are changing, right? There's like 450 ETFs for ESG on the market available. Investments have gone up 10x in the last 5 years. Like it's gotten pretty hot and heavy. So let's talk about where we're at, as an industry as a whole, specifically real estate.
Sure. So there's been a lot of movement in the last 18 months. So the application of these ESGR metrics has spread across the industry. And it's gone from being a question that was asked on a questionnaire somewhere or someone thought about it to now it's a gating criteria, right? You must answer that you have an ESG, a robust and active one, or we're just going to move on. It's a dining room table topic and a boardroom topic, which means we're feeling the pressure from all sides. Fantastic. And investors know that in order to raise capital, developers and such, that they have to pay attention to this and address it. And they also know that in order to engage with their customer base, whomever that might be, from the individual who lives in your building to the decision maker on a transaction, you have to have this. And the money is significant, right? If the UNPRI, the United Nations Principles for Responsible Investment, there are 2,400 investors who have $86 trillion of assets under management, right? Wow. Today, 70% of institutional investors have an ESG policy. That number in surveys will be 80% by 2023, right? So everybody's asking the question. How they're applying it is different.
Yeah. So that's exactly right. I love it. I mean, it sounds to me like it's picking up steam and it doesn't, it's not slowing down anytime soon. This is fantastic. And let's talk about certifications, right? Because this is what we're talking about. There's marketing and then there's practice, right? Like, what are we actually doing on the ground to make ourselves, sort of govern better in terms of adhering to these standards and these strategies? Which badges do you think tenants, owners care about the most? I know there's more and more certification bodies that are coming out, but which ones seem to impact lease revenue, expenses, value? Which ones matter the most, and what does it look like in practice?
Sure. So I'll start with the tried but true LEED certification. Right, that's been around of the menu of options, that's been around the longest. Yeah. And Cushman & Wakefield just published a report last month or earlier this month that said buildings that are LEED certified, Class A office urban buildings, sell for more than 20% higher price per square foot on average than non-LEED certified. And wow. ESG signaling buildings lease at more than 10% higher rental rates than non. So on the sort of transaction funnel through to the investor and the investment sales, it's realized and realizing. On the user side, the individual, right, you have lots of little badges that can be on the outside of your apartment building or your office building or your shopping center. And really that's shorthand. That's signaling to that individual that we care about the environment. We care about wellness. We care about you.
Yeah.
Everyone is a little bit different, and the next level of engagement will be, if you say you do this, then you need to do it and report on it.
Right. So it's like if Google wants to become a tenant in your building, they might hold you to a different standard than just maybe a shopper at a retail outlet, right? Or a resident looking to rent a unit, right? They're like, I just want to know what the rent is. But, it's nice to know, right? It's like a nice to have for the renter. But maybe in a tenant situation where you have a large occupant coming into the building, it makes sense because perhaps maybe it helps them like have lower expenses, right, on their utility side, right? If it's like a net lease situation. Akshay, do you have anything to comment on like certifications, badges, how it matters?
Sure. I would say this. I think, with regards to certifications and badges, I think the relationship between value and both from an operational cash flow perspective as well as from a residual value perspective, as Mandi pointed out, is much more clearly expressed on the new end of the market, right, where developers are actively building and coming out with new inventory. I think what is now happening is that is now translating down to older vintage product. I think there are a number of groups that are working to translate, what that means in terms of economic impact from an NOI and residual value perspective for older product as it is being, added to in terms of improvements, both green and from a kind of utility perspective. And I think we will start to get more clarity on what that means for the bottom line of those operators. I think another place where that starts to factor in, and this is less immediately clear, right? But as you're starting to go down the value chain of different demographics, I'm going to steal a phrase from Capital One here. It's going to matter what's in their wallet, right? I think, tenants have a fixed amount that they're willing to pay. Mm-hmm. And I think they would rather allocate that spend to space, to amenities, as opposed to utilities where possible. So it is a very tangible I think, issue for them at the end of the day to have, that spend go to something that matters to them as opposed to use on utilities or other facilities.
Makes sense. Let's talk a little bit about the financial side of it, right? Because I mean, that's what's driving a lot of this. In terms of like green lending and ESG investments, how do they help de-risk properties and make them more resilient?
Sure, I would say a couple different ways. I think the first is, expressly there's a lower cost of capital through many of the larger programs, whether you're looking at HUD or any of the agencies, right, Fannie Mae or Freddie Mac. Each of those have green programs, and I think the carrying costs of, the borrower in that case would get reduced if they're engaging with these programs and making certain improvements. I think obviously the other way is by reducing the operating expenses. Now, we're in an environment where those cap rates and debt yields that are effectively being used to multiply those values are now more pronounced than they've been in a long time. And so each of those expenses, as you're starting to reduce water, starting to consider, avenues to reduce insurance costs, starting to reduce your gas or electric bill, that's getting multiplied by a larger factor than it ever has before. So keeping that in mind, you're able to reduce both your carrying costs on the front end through both, reduced interest payments and reduced expenses. You're able to amplify the impact of those reductions on the back end. But at the same time, you're also able to engage with the tenant and say, hey, now that you're not paying $25 for water, is there another amenity I could offer you that is a differentiator as opposed to a deterrent, right? And I think that is really where this is starting to kick in.
Right. And so you're starting to see, do you see savings on the actual loan rates themselves and how that drives value?
Absolutely. I think there are very explicit programs. For example, the HUD MIP program is one such program where you are getting a reduction in your mortgage insurance premium, which is, tied to your monthly payment, right? So there is a reduction in that program. And with certain other programs, there are increased sizing parameters, right? So if you're thinking about it in terms of your total cost of capital, you're able to actually extract more loan dollars at lower cost as a function of your total needs as well. Through programs like the Fannie or Freddie Green programs.
Right. And does technology play a role in the outcomes after acquiring these types of loans? Like, because I know some of the programs, I think you've mentioned before, is there's certain amount of spend that's required to like upgrade these particular properties. Are you seeing that they now have an opportunity to use this funding for capital improvements that help them be more efficient?
Absolutely. I think where a lot of the funding was concentrated before, and I think this is partially due to a lack of information, is that you couldn't really see what the direct ROI on those improvements were, right? So if I'm compelled to spend a certain amount based on a certain program requirement, whether that's with Fannie Mae, Freddie Mac, or HUD, in order to qualify for a green program, I would rather spend those dollars on a high ROI item, in this case, utilities, right? Yeah. Because I can reduce the utility burden on both myself and the resident. I can potentially charge higher rents, which is much more accretive because, again, that tenant has a fixed amount of dollars that they're willing to allocate. And at the same time, as Mandi mentioned, I can improve my residual value by getting to a certain standard that may qualify for, another investor's line of sight when it comes time for me to exit that asset.
Fantastic. And then on that topic of ROI, Mandi, is the evaluation of ROI for ESG investments different than other investments? If so, how? And, follow on. I think you have another definition for ROI too, so I'd love to hear that.
Yeah, I would say that the evaluation isn't different. It just adds another layer or provides another lens that you put on top of it. So you still have the financial metric. You still need your strong risk-adjusted returns for the numbers to make sense for your capital investment. Yeah. And then, so that's the traditional ROI, return on investment, math calc. And the second one is a relevance lens. I call it a risk of ignoring. If you're not paying attention to what's happening around you, you get left behind. Yep. Nobody likes to be left behind. Investors in particular don't like to be left behind. Yeah. So it's important to stay relevant. And you use this lens to look at what other things can we do to maintain the value, to maintain our relevance, to underwrite differently, better. What other things can we be looking at? And you'll see this in the context of if all the other investors in the cohort are underwriting a building and applying the ability to install technology and get a better outcome for both the resident and the building, but I'm not valuing my building correctly, is my humble opinion. So that's your valuation risk. During this transition period, you have that valuation risk.
Yeah.
You also have the decarbonization laws and all of the things that the cities and jurisdictions are layering on top of buildings. And if you don't pay attention to complying with those, you're going to get behind. It's going to be hard to catch up. It'll be expensive to catch up. And who's going to lend you money? Not green financing, definitely, but who's going to lend you money on a building that's not compliant? Who's going to pay a value you think it's worth? Nobody. Who's going to rent your apartment if you don't get to have the little sticker that every other building up and down the block has? So I feel like if you think about the dollars as well as that layer of social impact and relevance, you'll create value.
That's fantastic. I love it. I love it. And, you know, what is the risk of ignoring? I love how you put that together. And we're going to shift the conversation and talk about risk, right? But it's good that we've gathered this, and, you know, it sounds like putting sustainable, financial principles into practice and operationalizing a more sustainable business model can offer lots of benefit, right? Including better performance and ideally leading, it looks like you can have better access to capital, you reduce risk, and we're driving value here. So let's talk about, Joel, this question for you. We get asked all the time, is there anything you guys can do to help us on the insurance side? Because market conditions have gotten a little tough. So Joel, when it comes to risk, tell us a little bit about what's driving these increases on the insurance side. Is there light at the end of the tunnel, or is that just a train? Are we in for a ride? Tell us.
Sure. I mean, the insurance industry by nature is cyclical, right? And right now we're in a hard market. Unfortunately, this is likely to stay for the near future. We are seeing new capacity, come off the sidelines, but in reality, we think it's a little premature. We think they're just taking advantage of the higher rates that have been escalating over the last few years. And the rates have been escalating from a number of factors, right? Catastrophic events in the Southeast, the Gulf, Texas, wildfires out in California, the nuclear verdicts we continue to see out of our courtrooms, whether it's liability cases in Atlanta, trucking cases out in Texas. They're just massive settlements that are being levied on insurance companies and companies right now. Insurance companies' investment strategies have something to do with the hard market. They're heavy into treasury bonds, and bonds are they're trading lower from a percentage basis than they were back in the 90s. So that investment income that they're making on treasuries is a lot lower now. We have this kind of a surge of new construction happening right now. And so the insurance company's getting prepared, the industry's getting prepared for a wave of, construction defect claims that'll happen over the next decade just because of the amount of construction that's happening. It's almost, everybody with a hammer is out there right now. And then the backlog of lawsuits we've seen due to COVID, right? There's so many lawsuits in the courts that haven't been settled yet because of the delays from the past year and a half. So there's a lot of unknown that's coming out of claims that have happened years ago.
Wow. So it sounds like we're in for a ride. Yeah, I mean, and I like we talked about earlier, right? It's like, it seems like more of this is going to shift. And I think it was Akshay that mentioned that, right? Like these owners and operators are going to have to carry a little bit more of the load, right? Because these insurance companies are coming along, they're saying, we're not going to deal with your poor maintenance, or, perhaps you're dealing with labor struggles, right? Like you just don't have enough staff to manage, the 800 or 900 apartments in this massive community, and you're just buried, you're drowning, right? And the insurance company's like, the maintenance still on you, right? So if you have water leak issues or, water damage claims, talk about, we talked, is it regional specific? Like, are there certain markets that are getting impacted more than others? And I know we talked about this hard market condition, but we have different issues in Florida than we do in Texas and California and New York, right? It's just very different. But some owners have national portfolios, and others are more regional. Can you talk a little bit about certain markets and how they're different?
Sure. from a property insurance standpoint right now, I mean, coastal regions from North Carolina to Texas are seeing a lot of rate pressure. Texas HAB is the most challenging market right now. It's really, they're paying rates comparable to what Florida has been paying for years, right? They've now caught up because of all the hailstorms, because of maybe the infrastructure issues on the eastern side of Texas that they're having, right? So property is certainly hard, and we're seeing that right now. Countrywide, though, professional lines, the rates are increasing faster than we ever have. So your directors and officers liability, your employment practices liability, your errors and omissions. So your real estate guys on the call, your developers, those E&O classes right now are so limited with the insurance companies that want to take that risk on. There is no competition. I mean, you are at the beck and call of these insurance companies, and they're driving rates up. And quite frankly, I mean, developers are getting popped more for the developments they've done over the past decade, and it's just happening. So there's more lawsuits, and so insurance companies are not loving that side. And then the cyber market, watching it, we're watching this one in real time. Insurance companies are actually underwriting cyber exposure for companies. They're actually asking the questions. 2 years ago, it was how many employees do you have, and how much revenue, what limit do you want? That was it. Those 3 questions, and out popped, $3,000 for $1 million limit. Right now, it's if you don't have MFA, if you don't have certain cyber infrastructure, you will not get cyber coverage, or you're going to pay 3 times more than you would with something else, with the MFA and with different cyber infrastructure implemented in your organization. So that's changing. And then with the nuclear verdicts hitting the excess markets, right, we're seeing capacity change. So, these lenders are requiring 50 million, 100 million liability limits, potentially during construction or when permanent placement happens at the end of construction, right? These massive liability limits that are all being driven by the lenders at this point. And with these nuclear verdicts, these insurance carriers that were putting out a 10 million or a 20 million primary limit on the liability side are now bringing that back, and it's a 5 million primary, or it's from 20 million down to 10 million. And so once you have to start layering more insurance companies on the liability tower just to meet your lender requirements, everything's getting more expensive, right? So it's the excess market is also in turmoil.
Wow. Okay. So it's piling on. I mean, you see Florida, we see risk in areas of high levels of humidity and organic growth, which oftentimes creates hazardous situations that aren't traditionally covered by insurance. And you're seeing some pullback in the Florida market, right? With insurance coverage not even being available for water damage and certain assets. Is that correct?
Absolutely. I mean, when you have aging buildings, right? When you have 40-year-old apartments on the coast that really use, I think, insurance for a maintenance policy, those properties are getting hammered right now. You're seeing retentions, let's just call it Charlotte, garden style, 10 years old. They have a $2,500 water damage deductible. There's insurance companies now, though, that are refiling from one $2,500 deductible to a per unit deductible. So if you have a 5-story garden style, you have water damage from the top unit, and it trickles down into 8 different units. Right now, you're going to spend a lot more because it's 8 times 2,500 and not it's just a $2,500 deductible. So that's what you see with insurance companies. They, in hard markets, they increase rates, they increase retentions, and then they draw back on coverage as well. So
yeah, interesting. And then you had I think you had the Texas freeze condition that happened back in February of this year, and I think the economic damage was estimated to be somewhere around $130 billion from just a complete disruption. all the pipe freezes they hadn't seen in what, 100 years or something like that. And the actual quantifiable number that was actually attributed to insurance losses was somewhere around 20 billion, right? Like, so we have like a hard number on these assets that had to file claims, right, for water damage. Hotels had pipes freeze and just flood entire buildings, and apartment communities. I mean, it's just a massive disruption. And, you know, in a way, technology could play a role in helping to de-risk. You know, some things are just catastrophic, and they're catastrophic, and there's hardly much we can do. But there are some opportunities. Why don't we talk about the future state, right? Like, why don't we talk about if technology plays a role in helping to kind of relieve some pressure on the insurance side? Do you see, you know, improvements in potential underwriting and risk claims management? How do you see that?
Sure. You know, I mean, the developers I know, and you know, the real estate guys, clients, I mean, everybody wants to pay, you know, the least amount for insurance, right? All coverage being the same. They want to get the best deal. It is what it is. It's just natural, right? So, you know, for you to be able to drive the best deal, the owner has got to be willing to transfer, mitigate, and avoid risk, right? You've got to change the facts about how insurance is based. Frame, garden style, coastal Florida, they're already going to be paying a higher rate. Now let's see if we can claw back some coverage by implementing, you know, technology, right?
Right.
You know, let's just say you've got two properties, or you got a property with a history of water claims, right? And at this point, in this kind of market, you've really got to meet that challenge head on. But the developer, the owner, has two choices: repair and move on, or, I mean, implement a water mitigation technology like Kairos, right, to mitigate this risk, right? Insurance companies always ask, is like the first thing. If there's a history of claims, insurance companies want to know, what have you done to prevent these claims in the future, right? If there's a known problem, insurance companies are very weary about getting on a property, or they're going to charge you an astronomical amount because they know there's going to be another water damage claim. It's not if, it's when, right? So if you haven't, you know, if these owners haven't changed the facts, right, about that property, implementing risk management technology, then they're going to get the same result. It's going to be increased premiums, increased retentions, you know, less coverage for water.
Yeah. Let's shift a little bit on that topic. I mean, we've talked about the risks, and we see that, you know, there is potential, but the insurance industry, my goodness, they are risk averse as any, right? And so when it comes to even trying new technologies, right, like, in a lot of ways, they've kind of dipped their toes in the water, so to speak, right? And we're starting to see some validation points, right? Some anecdotal proof that this works, right? And we see 80%, 90% reductions in claims for those who have risk mitigation technology for water. But you can't stop everything, right? Some buildings, if a 6-inch pipe busts, I mean, you're in trouble, right? But you know, let's talk a little bit from the operator side, or, you know, those who actually manage these properties. How are you seeing you know, real estate companies change things up a little bit, Mandi, when it comes to dealing with the insurance risk? Are you seeing them putting technologies in place to help with risk, whether it's on the construction side or the operation side once they have the building up?
I do, yeah. So I see companies looking at, and this is just, I talk about this in an allocation of resources, right? Resources being money, time, and energy. So what's your biggest challenge? What's on fire? Let's go fix that. So if they know that insurance is rising, or they had a series of claims that they know is going to impair the value going forward, they'll go find solutions to fix it. And they're solving that one problem. Where you can take that and amplify your value is say, okay, so let's take Kairos as an example. Why not? Let's install a leak detection digital solution, and that'll help us actually address the problem of the water infiltration, number one. Number two, maybe not this year, but next year, it'll help our insurance premiums. And number three, we get to talk to our customers about this, right? So we've created value on multiple levels here. And if you can take that framing around technology as a solution, not just to your immediate pain, but to creating value, you win. And so a lot of owners are thinking through that. Where they move and what they're doing first, it's a different solution across the board, different results as well.
It matters whether you have a vintage of a building that's a little older or newer. What's interesting is we're sitting in a building right now that's about 6 years old. It's 80 stories, and they've got 800 apartments in this building. And they've got probably 10 water closets that got PRVs. One failed, it leaked down, 8 floors, right? Like, and I asked the building, like, what do you guys have in place to deal with this if this big pipe breaks again? Nothing. So it's time to change, right? It's costing them, it's starting to hit them. The insurance deductibles are going up, premiums are going up, and it's creating a lot of exposure. So I think the time is now better than ever. It's just an asymmetric market condition that we're seeing, right? Between single digit adoption of technology and 40-50% of these assets seeing some kind of claims activity, right? Akshay, do you have anything to comment on that as we roll in to talk about R&M?
Yes, absolutely. I would just say that, I think the insurance expense over the course of the last couple of years has become kind of a larger percentage of operating expenses, right? It's historically been, first or second, depending on where your tax situation is, from an expense category, right? I think now what we're starting to see is there are certain markets, as Joel mentioned, where insurance is getting extremely pricey, and that curve has gone up 30-40% over the course of the last year or so. And it's now cost prohibitive to go into those markets because, that cost increase is now being multiplied by an even larger valuation metric. And so I think to the extent that there are technologies like Kairos available that directly address those issues, and even lead to incremental, 3, 4, 5, 6 percentage points of kind of risk perception reduction from the standpoint of the carrier, I think that gets multiplied by substantial multiples. And I think, it's making a bigger impact now on the P&L than it ever has before.
Yeah, it's something kind of, as the sands are shifting, you're starting to see, exposure arise where it wasn't there before, right? People were comfortable, things changed. As Joel talked about earlier, Texas was getting, comfortable with having low rates because they didn't have any, crazy, wildfires or, 100-year floods. But, as the climate shifts in different regions of the country, I mean, you could literally split the U.S. right down the middle. The West Coast is completely dry. The East Coast is drenched, right? We're seeing floods going into subways in New York City, and you're like, wait, what? We haven't seen this in Sandy, right? Like, so it's just things are changing, and it's gonna create more and more risk, and these insurance companies aren't gonna always foot the bill, right? It's eventually gonna have to shift on some kind of strategy that these operators have to be more defensible, right? Let's talk about. Go ahead.
No, just add one other quick point here, which is that I think, historically, we're dealing with the slow moving asset class, right? We're dealing with stuff that traditionally transacts once every couple of years in terms of change of ownership. And you were historically also dealing with climate that was only kind of impacting your, profit and loss or your bottom line every so often. The frequency of both of those things has changed and accelerated. So I think, to both Joel and Mandy's points, I think we will now see that curve kind of accelerate much, much more. And I think the willingness to take on technology to adjust for both tangible and perceived future risk is now much more in flux and for the positive than it has been before.
Yeah. I have, let's talk about like where do you see the most significant room for improvement when it comes to R&M and how it's conducted today? Akshay, you want to take that one?
Sure. I think there's the legacy model of inspections and taking a look at aging schedules to see, what things historically should have been replaced after a certain use period. I think the way we like to look at it is not only taking a look at useful life, but also taking a look at unitary values. And again, going back to the ROI point, right? What is the biggest driver of kind of the returns on your bottom line, right? So, and that not necessarily all short-term returns of what's going to impact my NOI tomorrow or reduce my turn costs for next month. It's also from the standpoint of, okay, when I go to sell the asset or refinance the asset 2, 3, 4 years down the line, you know, when those buyers or lenders are coming in to take a look at the asset, how are they going to assess my valuation?
Right.
And I think it's become much more itemized than it historically has been. I think historically, you know, that's been relied. I think you've relied on external inspectors, you relied on PCNA reports, you relied on kind of a very somewhat bureaucratic process, I would say, to get that information. I think now what a lot of operators are doing with technology providers up and down, you know, different tech stacks, both from an app perspective as well as from a web perspective, is that they're able to take a lot of that on themselves. They're able to basically say, okay, I can now track my useful life, my warranties, track my, you know, the replacements I've made in a much more delineated fashion.
Right.
And that's allowing them to say, you know, identify where the key choke points and bottlenecks are and adjust for them. I also think, you know, with the internet and with kind of the proliferation of different marketplaces, I think your supplier choice is now much more expansive than it ever has been. Right. So you're just not relegated to, you know, suggestions by third-party providers. You're now able to access those end providers of materials and providers of appliances and providers of sensor and technology, for example, in your case, directly. And you're able to interact with those, and you're able to you know, get them to install directly rather than going through kind of middlemen that have historically been part of the system.
Absolutely. Mandi, do you have a comment on that? You know, what area do you see, you know, has the greatest room for improvement when it comes to R&M? We see an aging labor force, you know, especially in commercial buildings, right, where your average age is north of 40, well over 40, and then the next nearest group is below 30, right? So there's a massive gap. A lot of these building engineers are going to be retiring, and the knowledge of these buildings is inside their heads. Where do you see the room for improvement in R&M and you know, tackling labor struggles and all the challenges that we deal with?
Yeah, I would say that the demographics, the change that's happening in the labor force, aside from just the fact that the labor is much more mobile today, but that change in the demographics is a huge pressure that real estate is experiencing, both on the input side, the people who run the buildings, and the user side.
Right.
And you're absolutely right. The average building engineer was trained 30 or 40 years ago, very much high degree of mechanical skills was the threshold to help you be successful in your role. And today you're asking people who were prized and trained in the mechanical side to now take those skills and apply them to problem solving in a digital world where they've had some training most likely, but not the same weight of 30 years of experience and training. So where you have a successful application of prop tech, the rubber meets the road at the individual, at the building who's going to respond to that technology's information or not. And so it's about training and supporting and engaging that individual, the building engineer, the building team, so that they see the value. It makes their job easier, gives them time back in their work life to do other things that need to be done. Then you'll see success. But that's a shift that we haven't seen yet. Probably a big piece of it is because, yes, real estate is slow to adopt technology. Yes, most of the real estate decision makers were slow to adopt technology as well, even though their customers and their teams demand technology.
Right.
So as that sort of settles and works its way out, we'll see more technology. It'll be pervasive in a different way. In an office building, it hasn't been. In an apartment building, it's been a little more.
Yeah. And I mean, it's shifting, right? And it's not, I don't think it's going to reverse, but there's always going to be this relationship between technology and humans, right? They're going to have to interact with one another because you have the decisions that have to be made on the ground, or if you're alerted about something, you still have to send a human to go fix it, right? It's just you're doing more with less, right? You're going to have to be more efficient on the ground you know, one building engineer may be looking at 5 or 6 buildings all on one dashboard rather than, you know, having to walk. I mean, we just walked this building and it's 80 stories tall. You know, it is massive. And every morning they have to walk the building and go up and down it and check every mechanical room. It's like, you know, what if something as simple as a camera could give you visibility to see certain things, right? What if you know, you had sensors that could just tell you temperatures of different conditions in these environments, right? It actually creates logs that can be transferred from one engineer to the next engineer, right? And so you start to create this transition of data, and how do you think that plays in? Like, are you seeing data really play a massive role there, Mandi?
I am. Yeah, it's the flow of data is sometimes not available in a building, but it can be when you install tech, it's installed sensors. It's what comes out of that data. You need actionable items that produce value of some sort. Yeah. And so having predictive analytics useful from that data, so you know what you're, like Akshay was sharing about, you do your regular R&M maintenance, right? You pull out the book and you say, oh, we're going to check this filter and we're going to do these things. You have that. And then you have all the other things that happen during life and the operations of a building. Right. How does the data that you've collected, that you've managed with this building, as well as probably a peer set, nationally, globally, if not your sub-market, your micro market, how does that tell you what to look at next, what to expect for tomorrow, what to plan for, how the weather will impact this, all those things, right? If you can use the time, which is the most valuable resource we all have, right, is our time. If you can use that to, instead of running down a problem, say, oh, this is happening, I'm going to prepare for it. Yeah. You've created a better situation for the building, for the resident, and for that individual who's running that project, right? And the ability to transfer that knowledge is really important. Sometimes now the building engineers transfer knowledge by leaving sticky notes, right? When they retire, here's the password and here's how to do this, right? Yeah. So you got a wall of sticky notes. Well, the next evolution will be, you know, you actually have data, you have logs, you have history, and here's what that tells us about what's coming next.
Yeah, I love it. And you know, I hope this to the audience, at least, it brings it a little bit more clarity here, right? Like how all of these different segments interact, right? I mean, you can see that if you're struggling on the labor side and you've got more exposure, what's going to happen when you have a claim, right? It rolls over to the insurance side, but you can see how the struggle is very real, and you can see these opportunities, right? Like, where can we improve? On the financial side, you have access to lending that Akshay mentioned about for you know, for improvements, for efficiency. So we can hit our ESG targets. We can you know, be more proactive about our maintenance by the utilization of technology. It can help de-risk so that the insurance companies can feel a little bit more comfortable about underwriting these deals. I see how this is all tying together, and I hope this has provided value to the audience. Lastly, I'm going to ask you know, each of the panelists here final thoughts. We're almost over at the hour mark here. Let's start with Akshay.
Sure, I would just say this. You know, I think, as Mandi mentioned, we're now in a more integrated kind of workplace than ever, right? And I'm speaking from the perspective of an operator's workplace, right? So if you're looking up and down the organizational structure, whereas 10 years ago, I might not have been able to see what the engineer was seeing, I can now click through from an income statement into that water line item to see what the usage was at any given point in time. And the causality of that is now clearer than it's ever been. You know, of the financial impact versus, you know, the stuff that's happening on the ground. And so I think that will only continue to accelerate and kind of proliferate, you know, the changes that we're starting to see in our space. I would also add that with kind of identification of that causality, you're able to kind of influence the decision-making up and down the chain, right? So it's no longer a property manager or a building maintenance guy's issue. It's starting to become an asset manager's or a capital markets guy's issue as well, because they're seeing this translate through, you know, the various kind of stakeholder access points. And I think more and more, we're going to start to see this become part of a top-down strategy than you know, where we've historically seen this kind of be a little bit more bottom up, right? So it's come from the teams on the ground, and then it's worked its way up the value chain. I think now you're starting to see it become part of the business plan, part of portfolio strategy, and part of company distinguishing things.
Fantastic, I love it. Joel, why don't you give us some parting thoughts about your perspective now that we've engaged these other panelists, and you can see it sort of from their side of the table.
Absolutely, and I think everybody's kind of dancing around it, right? It's historically insurance companies are really late adapters to technology, but they're investing more into technology today than they ever have. Right? They're relying more on modeling software, especially for large portfolios, to make these underwriting decisions for them, really to err on caution. But fortunately, these models still do allow for subjectivity of the underwriters, right? But the only way to tap into these credits that all these insurance companies can provide is by documenting what facts of that property have changed.
Yeah.
And the best way we have found is by, utilizing risk management technology to help us document that change, right? We've got to document that underwriter's file with the steps that have been taken by the business owner, the property owner, the portfolio manager, the operator. We've got to document their file, right?
Yeah.
So when there is a claim from a CAT event and the boss knocks on, taps on their shoulder, they say, hey, we did everything we could, right? That's why we gave the rate we did. And without that, it's hard to justify a decrease in rate right now.
Yeah, absolutely. I talked to the IoT Insurance Conservatory, and he mentioned, we eventually will go from having sort of this early anecdotal data to statistical data. When it becomes significant and we have enough of a data set, it will start to drive these insurance underwriting, parameters, right? But it's a little early in the market, and so don't bother your insurance guy too much about lowering your risk. He's just dealing with hurricanes and fires, right? Mandi, you got some parting thoughts, and then we should be able to wrap up here.
Sure. So I have three things to leave you with. One is technology is part of the solution. Embrace it. You can make a lot more progress with technology as part of your tool than if you're just using your hammer and nail to solve the problem. Number two is bring a diverse team to the table. We're finding solutions and making changes in complex and dynamic situations, and you need as many viewpoints, lived experiences, and perspectives as possible to find the solution. So build a diverse team.
Yep.
And the third one is, if it matters, measure it.
Yep.
Just like any business, make a business plan, set out your goals, and then measure your progress.
Yeah, absolutely. I think that's where exactly, my thoughts are, that the technology starts to give you these data sets to have that measurement, right? To then make those changes. So with that, we'll hand it back to Matt Ullman. Thank you everyone for joining the panel. Hopefully the audience got a lot out of it. I sure did. Thank you, Mandi. Thank you, Joel. Thank you, Akshay.
Dean, since we have like 2 minutes left, there are 2 questions. Do you want to cover those?
Yeah, let me pop into the Q&A here. I see developers are typically short-term owners before they flip it. And considering the post-COVID functional obsolescence related to building projects creates a market not very receptive to technology. Is this true or false? Mandi?
So I would say a couple things. So yes, there's a whole cadre of developers whose job is to build, lease, and then sell it, get the best returns for their investors. And if you want the best returns, you need to get the best price. And the investors who are willing to pay the best price, they buy the best products, right? They're going to buy the trophy building, the best performing building, and you can't skimp on that. And if you don't have technology in your building as a new product or a renovated product, then you don't meet their threshold for purchasing it. If you want to sell to a core investor, you need to have a core quality product, is my take on that.
Yeah, fantastic. Yeah, I mean, it's just going to shift, right? If you just are just trying to go for the short-term flip, I mean, it can be hard to justify, but yeah. Okay. Akshay, do you have you want to comment on that?
Just one other thing I would add to that. I think, it kind of goes back to what's in the tenant's wallet, right? I think you can't make money off utilities. You can make money off of rent. You can make money off of amenities, right? So to the extent those utilities continue to consume a large portion of the tenant's bandwidth, it's eating into the potential revenue, not to mention the operating expense side of things that asset can achieve. And to Mandy's point, that ultimately works its way down into the operating income, and then once it's capitalized, works its way into value. So I would just say that I do think it needs to be factored in, because it's now being amplified through extremely low cap rates, and I'm sure whoever is buying your assets is factoring into their financing as well.
Yeah. So someone asked the question. Thank you, Akshay. Someone asked the question. Last question here on the insurance side. We've offered safe driver discounts or using technology. Do we see this potentially, Joel, applying to facilities operations and practices there on the insurance side?
Yeah, absolutely. I mean, like we discussed, if you change the facts about how insurance is based, then you can get credits, right? And the only folks that are going to get the best-in-class credits are the ones that are doing the best-in-class implementation on risk management. Whether it's you're not using your deductible or you're just not having claims.
Awesome. Love it, Joel. Matt, back to you. I think we're wrapped up.
Yeah, we're right at time. Sorry if there were other questions that we didn't get to, but Dean, you want to real quick let people know how to get in contact with you?
Yeah, absolutely.
Follow up?
Yeah, you can follow up with us. You can find me on LinkedIn. Obviously, you can email my Chief Growth Officer, Davin. That's DAVIN at kairoswater.io. That's KAIROS water.io. So that's Davin at kairoswater.io. We'll leave it, on our website. We'll post it on LinkedIn. And thank you, everyone, for joining.
All right, great. Thanks,
you.
Dean and panelists. Appreciate the insights. That was super valuable.
Okay.
Everybody have a good rest of the day, and see you in the rest of the sessions.
Thank you.
Bye.
Bye.
Bye.